So the first one, like somebody just asked, where if you have something like this, a downtrend, right? Say this is the daily time frame, so you're going to have potentially IFCs on each one. Reason being, we can kind of assume that they're going to be IFCs. Obviously, the lower time frame will confirm it. If on the lower time frame you can see the right things we want to see, which is distribution happening, or if on the lower time frame we see equal highs in FU candle, that indicates to us that on the higher time frame is likely to be an IFC. Also, tying in imbalances, which I'll show you later on, it kind of gives us a bit more indication that it is a true valid IFC. So when you have consecutive IFCs like this, you're going to still in green. You're going to have I probably didn't draw this the best, but you're going to have a series of mitigations. Assume this came. So when you have a series of mitigations like this, when you're seeing consecutive IFC mitigation, the process of mitigation actually forms a new IFC, which later on therefore needs to be mitigated. And if we are seeing a series of new points of structure, that is actually showing us what the institution's intention is. We like to call this order flow. Now, I don't know if this is a traditional component of smart money. It's just something we kind of figured out and developed ourselves. Maybe it does exist already, I don't know. But this order flow kind of stuff, it tells you a story itself. Because if on the lows over here, we are just seeing, on the lower time frame, if we zoomed in, we were just seeing normal price action, break of structure like this. And that break of structure over here, we had an IFC and mitigation like so. That is just normal price action. This is just normal lower time frame price action, and it's obviously a lower time frame break of structure leads to a higher time frame break of structure or a higher time frame movement. So if we are seeing consecutive healthy price action or normal price action on the lows, every time there's a new lower low, but every time there is a higher low, so here, etc. If we are seeing that these the things I've done in green, the IFC that are being formed, if they are a process of IFC mitigation formed by a new IFC, mitigation by a new IFC, etc., that is showing us that the directional bias of the institutions, the money being pushed, is to this direction. So even if we were seeing, this IFC being formed and that mitigated this previous one, and now we're seeing, okay, that is probably indicating to us that we have bearish order flow. So if I started to see some sort of accumulation here on a lower time frame, I would therefore in my mind be able to realize that this is probably indicates to us that is most likely counter trend. Why? Because institutional directional bias for this time frame at this moment is bearish order flow defined by these consecutive mitigations that are happening. So that kind of gives us a little bit of an edge or understanding on what direction we should be looking at. And if this lines up with structure, so bearish structure lined with bearish order flow, that is a strong indication that we should be looking for sells, and vice versa for buys. Okay, now a cool thing that leads on from this is the thing that it was actually Wiley who created it, and we kind of pieced it together as a team. But basically, like I was mentioning yesterday, we had our window. Actually, let me write this down. So this is the key window we refer to. Obviously, look at it up on your local time zone. But essentially, it's the crossover between London and the beginning of New York session. So in the beginning, we would only take trades in that window, and that would be our only place where we would actually execute a trade. We'd obviously be monitoring, during London, we'd be monitoring throughout New York, but we know because of this window, we started to notice that initially this wasn't a rule, that we were just trading freely. And then when we started to backtest, we started to realize a lot of the most meaningful mitigations that we found and a lot of the wins that we had happened to be in this window. And we also started to notice that a lot of our losses that we had, or a lot of break-even trades, more importantly. So you had a mitigation, but it did not fulfill. You had something like this. So you have an IFC over here. You have this mitigation. You have a small move up, but then it comes back down, hits break-even. So that means that we had a mitigation and we had a reaction that is normal. That can happen on any time frame. That can happen at any point in the day. But these are not the trades we want because we risked our account just to hit break even. Not good use of our time, not good use of our capital. But we found that a lot of these non-meaningful mitigations happened outside of that key window, and a lot of the meaningful mitigations, so the mitigations that happened that led to a break of structure or led to a whole swing trade or led to an intraday position or whatever the case may be, the meaningful trades that we were looking for happened in that key window. So basically, we had this rule that we created that we want to only trade in that key window, and that's something we were doing for 6 months plus. But what happened was, as a result of that, as you can all imagine, we were missing a lot of opportunities. And that's fine, because in trading, what you need is not to maximize on opportunities. You need to have patience, and you need to have a plan, and you need to have a system. And then when things fulfill your rules, then you know that your risk is justified. You have, like I was saying yesterday, imagine you're going to a court and you're presenting a case as a lawyer. You need to have built a strong case for each trade you are taking, and it needs to be justified. It's not just you can see that it's going to play out and anticipate that. That is low level, and being a low level analyst. What we need to do is actually have a whole case in place and practice some sort of discipline. So having that key window is one rule that we had. But as a result of that, we were missing a lot of trades. Meaning, we saw, we would mark something out on a Sunday, and on Tuesday London session, it came to that zone and we had the mitigation. Let's actually draw that out. So obviously we want a mitigation of this IFC candle. That is the analysis we were waiting for. And obviously our key window is something like this. Whatever. Okay. So what we would see is that we would have the reaction we wanted. It would come to the zone of interest. It would come before our key window, and then we would have the reaction. So when price came into our key mitigation window, the trade had already seemingly played out, and we were therefore thinking, okay, we've missed out on the trade. We have to obviously practice our discipline, and we will be happily missing that trade. But again, it's not something ideal, because this could be something we were waiting on for a couple of weeks. There have been times where we've been sitting on a trade, as in a piece of analysis, and we've waited over 1 month for it to reach that certain zone. It's actually something we've done in our telegrams too, where we publicly call a trade, and then it comes to that zone a few weeks later. So it's pretty frustrating where you see a great setup playing, great setup presenting, and it comes to your zone and it just comes narrowly misses. So we was thinking, okay, how can we, still get in on the trade that is still sensible? Obviously, we never want to chase a trade, because that's where you're going to make mistakes, or that's where you're going to mess up your risk to reward, or that's where you're going to take unnecessary losses. So that's something we would never recommend. But we were trying to think, how can we develop a way that we can accurately enter upon a trade once it's already had the ideal opportunity? We've missed the ideal opportunity because we were not looking at our phones, we were not on the charts, and we were not in our key mitigation window, whatever the case may be. What can we do about that? So Wiley developed something, and then we tested it out. So that's what I'm going to teach right now. But before I do that, I want you to realize actually the significance of the key window. The key window itself, I used to think, when we've kind of figured out, okay, this is probably a logical thing to do, because New York session, London session crossover. In the beginning of New York session, you're going to get a spike of volume. So it all lined up. But there's been certain occasions where I've been looking at a trade and it's been maybe 25, 30 minutes before the key mitigation window. So like 6:30 a.m. New York time. So I've been, waiting for a trade. It's come inside my FU candle, so I'm looking to take an entry, and I'm thinking to myself, okay, the mitigation window is only 25 minutes from now. Likelihood is like it's in my zone. I should just take the trade, and I've done that on many occasions where I just thought, okay, let me, it's close enough and it's near enough my window. It's in the zone of interest. I'm going to take the trade, and there has been many occasions where the price has, continued to go up. So say, for example, this was right before the mitigation window, and I enter my trade over here like this. I've noticed on so many occasions that price continues to go up, and the moment it hits 7 a.m. New York time, that's when I've started to see a reversal. So it just goes to show that this mitigation window is quite meaningful. Another thing that I've tended to notice, that a lot of the losses we took that were taken in the mitigation window, if it is taking towards the last hour of the mitigation window, that for us was like, okay, that's more of where losses came. That's got nothing to do with any theory or anything. It's just something we tended to notice. So the earlier on it is during the mitigation window, the better. That's one thing we noticed. And another thing we noticed was trying to, trade just before or just after the key window is probably not the best idea either. Having said that, that's not something we say avoid. There's going to be opportunities throughout the day, but that's just something we've tended to notice when we've, backtested our journals and had a look through what we were trading. Actually, the point I wanted to make from this was this. So we've missed our prime entry, and the reason we've missed it is either we were not on the charts and didn't see the opportunity, we didn't have an alert set, so we didn't actually notice, or it didn't fit your criteria of when you want to enter a trade. So for whatever reason, you have missed the prime entry. Now, as we know, higher time frame structure always derives from lower time frame structure, the fractal nature of the market. So any break of structure on the 4-hour is obviously going to be starting with a 15-minute break of structure, which obviously is going to be starting with a 1-minute break of structure. So structure is all consecutive. So what Wally and then we later on went to develop was called the banker block. Okay, so this is a zone of interest for us. We're looking to enter upon this FU candle. Okay, so if we are here now in this point in time, and that's where it's entered our key mitigation window, or we have just come to the charts and we've noticed that we've missed our opportunity, how can we re-enter on a trade? And this is not only for missed opportunities. At times, this is something I prefer to do because now I've seen a confirmed rejection. So in this situation, what we have seen is area of interest, price has come to our area of interest, we've had our mitigation, and now we've had a break of structure. So now what does that tell us? That we had a zone of interest that was looking for a sell opportunity, and on the lower time frame, the market has presented that sell opportunity and confirmed to us that there is some sort of rejection. So now what we can do is see, okay, we've had that confirmed lower time frame rejection. Maybe we're going to have some sort of equal lows. So that's fine, equal lows equals target. So now what we can see is that this over here, similar to the order flow stuff we were mentioning earlier, we had an IFC being formed as a result of a mitigation. When you have an IFC being formed as a result of a mitigation, we call it a banker block. A bank block equals an IFC post mitigation, and as a result of that, because it is an IFC in itself, is just defined by the IFC was formed in the process of mitigating a previous point of interest. We know that this needs to be mitigated itself. So this is a lower time frame example. So what we'll do is we'll have our entry, stop loss, and that would be our actual entry that we would look to take. Like so the reason that we like to take trades on banker blocks is multiple reasons. Reason number one is if we missed our ideal points of interest, and therefore we need to actually ladder in an entry. That is reason number one. Reason number two is if you really believe in the opportunity, what you can do is have your initial entry based over here. Oops. Have your initial entry based over here. Once you've had the breakup structure, obviously you're going to break even on the first entry. So now you're risk free. And what can happen is if you had a solid entry and price comes back, you can re-enter on the banker block. So now you can have one risk-free entry and then have a second entry. So therefore you're compounding, you're compounding, and therefore you're maximizing even more on the trade. That is reason number two. So we can stack entries. Reason number three is if you have a zone of interest, but you're not sure, you have a bit of doubt on that entry, what you can do is wait for a price to come to that area, wait for that lower time frame rejection like this, and then enter only upon the banker block. Because now you're seeing not only is your zone of interest true from your analysis, you have to actually have some live confirmation that you see some sort of lower time frame rejection showing to you that, okay, if that lower time frame is rejecting and I believe it's a point of interest on the higher time frame, I'm getting some more confirmation that I should be taking that trade. And as a result, you have more confluences to enter upon. Therefore, you're more likely, or it's a higher probability setup, number one. And number two, in reality, the banker blocks are usually smaller in size compared to the initial FU candle or IFC. Therefore, if it's a smaller candle, the banker block, you have less zone for risk. So the likelihood is if you're entering upon a banker block, you have greater risk to reward and greater precision, because you have precision being, accuracy. You have greater precision because it's a smaller stop loss, and you have greater accuracy because you have increased confirmations. So that's the two reasons for the banker block that we like. But just to generally briefly explain, if it's not to do with that lower time frame kind of stuff, what we can also present it as is this. And say, for example, this is on Monday, and then that leads to, actually, let me, we, say, for example, this is on a Monday, and now we're on Tuesday, and now price is starting to retrace over here. So it's not a lower time frame play anymore. This could be the 4 hour. We can still enter upon this mitigation of this IFC, and this would be therefore considered a banker block play because you're mitigating something that's already been created. Actually, I forgot to mention. So IFC number one over here. Therefore, we want to enter over here on the mitigation of that. So that's the ideal play. The ideal play already happened. We didn't get a break of structure, so we're still valid. We're still valid to enter because our directional bias for this situation, we want to make a new low. Price comes back up, and this would be your re-entry. So it just goes to show the point I'm trying to demonstrate here is a banker block play does not need to be a low time frame play. It can be also on the 4 hour or daily. It's just to do with that order flow stuff that we were mentioning. So we're getting IFC over here, mitigation, a new IFC formed, mitigation, new IFC formed, mitigation. So that would be indicating to us, okay, we have some sort of bearish order flow, and the banker block itself is a manifestation of continuation of that price action, and it is essentially another form of IFC. So this is something we kind of started to piece together maybe back in February, March this year. And to confirm that for us, is if that's something we wanted to utilize, it's something we noticed a lot that we didn't really have the concept of banker block in our minds. We just thought of them as, okay, we had a lower time frame break of structure, and therefore we want to enter upon another IFC. We didn't really term it the banker block at that point. But we noticed that we found ourselves doing that quite often, not just for if we missed an opportunity, but for rescaling in an entry or actually getting a better entry because it's a lower time frame entry. So when we started to do, we were doing that for a couple of months. We noticed that we are getting a lot of these things. Later on, when we discuss the momentum trend line, you'll see further what I mean by that and why we were doing that so often. But when we started to realize this was happening quite often and it presented a lot of times, then we started to backtest and we realized, okay, this banker block thing that we're thinking of actually has some validity and maybe it's something we should add into our trading plan. But that does not mean we just simply add it in. So what we did, or what Wally did was, once we found in our experience that it was something true, and then we started to backtest it and found it was actually very true. Before we added it into our trading plan, what we did was Wally opened a £1,000 account, and for the space of, I think, Wally, do you remember how long you tested it for? You might have to unmute yourself. But I think we tested it for maybe a space.
It's just around a month, I believe.
Okay, so you started a 1K account, and what we did was we were taking all of our normal trades, but we would only take an entry based upon solely the banker block. So like a scientific experiment, the only variable we changed was the banker block itself, and everything else was constant. And that account went from 1K to 11K, 1K to 11K in the space of a month, all with using risk management. And that for us confirmed that, okay, the banker block itself is something that is profitable. Therefore, it is justified to enter into our trading plan. So that's the process I like to call back testing. So first we came up with an idea, confirmed it in back testing. Once we found some validity in it in back testing, we stress tested it. So we open a small, 1K account and take trades solely based on that. And then once we see that it's a profitable strategy, then it's justified. The stress test was successful. Then it's justified to add it into our trading plan. So that process is something we've done for a lot of things that we've been working on. And that for us, not only is it a sure process that, okay, I've actually confirmed it and it's something worth adding in for the sake of your own trading psychology. If you're taking a trade now based on the banker block and something you've confirmed yourself, you're going to have way more confidence in taking that trade. So that's actually how you build your own resilience as in your mind and resilience as an analyst for when you come to trading live accounts, that you can have confidence in what you're doing. Not just because somebody told you it's true, but you've actually had real proof and real experience that it works. So yeah, that's the banker block story. Next, I want to cover actually the PDF. But yeah, actually, does that all make sense so far, what I've covered? Yeah, I'll show you guys some examples later on. But we'll show it in the lower time frame block later on today. Would you recommend only trade banker blocks? No, I wouldn't recommend only trading banker blocks because sometimes the real opportunity happens on the real points of interest and not always a banker block presents. So it's not something that I would recommend always waiting upon. But if you have a zone of doubt, where you're kind of interested in it, but it's not confirmed, I would definitely recommend waiting on a banker block scenario or the lower time frame stuff we're going to recommend later today. It will piece the two together. Could you go over break of structure whether IFC is valid or not? Whether there's a break of structure or not, an IFC is still valid. An IFC is not defined by a break of structure. Which candle is ideal entry second? Ideal entry, it really depends. We'll cover that again with examples because it's always case by case. If the banker block itself is a FU candle, yeah, it does make a higher probability because now you're getting the things we covered yesterday about the 3 M's. Now that the banker block itself is more likely to be institutionally funded, therefore more likely to need mitigation. Good question, Cameron. Break of structure stuff we'll cover again later on when we're doing the low time frame. Yeah, you can look it up yourself. But simply look where New York session opens in your local time, and that will define it for you. Okay. A summarized definition of a banker block is once you have a point of interest, that point of interest can be an FU candle or an IFC. Then you see a candle that is formed and rejects and mitigates that initial point of interest. So you have a point of interest, you have a mitigation, and in that process of mitigation, a new IFC is formed. That newly formed IFC in the process of mitigation is something we refer to as a banker block. That can be on a higher time frame and a lower time frame, and that can be with or without a break of structure. Hope that covered it. Yeah, it doesn't matter if there's a break of structure or not. On the lower time frame, there will be a break of structure. On the lower time frame, when we cover it, it will be defined by that. But on the higher time frame, not necessarily. Does a break of structure have to occur? On the lower time frame, yes, I would say a lower time frame break of structure is necessary to make a valid anchor block. On the higher time frame, not necessarily, because of the complex pullback. So I don't want to give you a blanket statement and say you always need to wait, because of what Alex covered yesterday. You can still see an impulse as in move. Just because it's a complex pullback does not mean it's negated. Can you repeat one more time the definition? Yeah, I'll repeat it one more time. The banker block is, so you need to think of a scenario like this in your head. You have an initial point of interest. That point of interest is defined by either an IFC or an FU candle. Both are fine. Now, when you come to that zone of interest, price comes to that zone of interest a few days later, we have a mitigation. And that's a normal mitigation. When that mitigation happens, we see some sort of rejection. That does not mean a break of structure. We just see price coming down. So we have a point of interest, we have a mitigation, and prices come down. When we had that mitigation happening, that initial mitigation happening, that formed a new IFC. That newly formed IFC also needs to be mitigated later on. So that newly formed IFC is what we refer to as a banker block, and that can be with or without a break of structure. Banker block can be, banker block and IFC and FU candle, everything applies on any session time. It can be outside that crossover. It's just the crossover stuff is something we found a bit more likely, so that's something we prefer to trade within. But you can enter upon it and they're valid on any time frame at any point in the day, including Asia session. How many mitigations would it take to confirm a trend or higher probability? With regards to order flow, there's no like a rule that the more you have, the better it is. But generally, if you have 2 consecutive mitigations, that kind of defines it, just like a trend line. If you have 2 points of contact to a trend line, look at it as 2 points of mitigation, defines that we have some sort of order flow. And obviously, the more that you see it, the more you're going to see that there is heavy bearish flow movement. But as is the case with the trend line, usually that third one is the one you want to be trading if you've already missed the first 2. Yeah, we'll show you plenty of examples of banker block itself later on. It's something very, very common. So it's not hard to, I don't have examples to mind, but I know that the moment I open my trading view, I can find a bunch of examples. Okay, I'll just do 1 or 2 more questions, then I'll carry on. After mitigations, is the point of interest no longer valid? Good question, actually, Francisco. If there is a mitigation and a point of interest, but that mitigation happened, let me actually draw that out. Equal highs, FU candle, mitigation over here. True that this IFC now or FU candle might be considered mitigated, but what about everything above? What about this area here? That is actually a very good question. That candle technically might be considered mitigated, but not the entire candle. So what do we do in that situation? Later on today, when we cover how we utilize imbalances, that will give you better clarity on how do we know if it's a true mitigation or not, or is the case this? Maybe we have a mitigation over here, and we have a reaction, and then price comes up and does this. That can happen too. And now this one might be your true mitigation. There are little things that we've noticed how to confirm that, because leading into a point of interest, leading into that, this is normal price action anyway, right? And then you have your break of structure, and then you have your bearish movement, etc. So that is going to happen regardless of if it's mitigating or not. That's just how price moves. You're going to get normal, healthy price action, normal structure. So say, for example, just for the sake of argument, I'm going to make this the POI. If that's your point of interest, if you entered over here, you saw a small reaction, but that was not a sustained reaction. We didn't get the follow through. We just got a reaction, and then it continued up, came higher, mitigated properly, and then we had the break of structure and what we want. So we need to actually understand, inside our point of interest, where is valid upon entering. That's why if you go back through my Telegram and you went back to August or something last year, you're going to be seeing me entering simply on a 4-hour IFC or a daily IFC or a 1-hour IFC, and it's simply going to be the open price. And my stop loss up here. And then therefore that whole area was my risk. That's something, if you go back far enough, you're going to see me doing. But more recently, if you see a trade and you find that entry on your trading view and you find this on the 4-hour, my entry is no longer here on the open. My entry might be over here in the middle somewhere, or somewhere seemingly random. And obviously it's not random, there's a reason behind it, but we start to understand inside the IFC what we need to be doing, or how to confirm some sort of rejection, or what inside the IFC needs to be taken care of. So that's what we're going to cover later on. But that was actually a good question, but that was a bit of a tangent. I just want to make sure everything's understood. Basically, both FU and banker blocks are IFCs, correct. They just have slight variations in their definitions, but at the end of the day, they're the same thing. To tap into liquidity where banker block is only found in order flow. Yeah, banker block is defined with the order flow or a rejection, not just order flow. We have mitigation. Some banker blocks can be FU candles, correct. Would be fair enough. Yeah, what you said here is correct, Cameron. If IFC candles sometimes don't get mitigated straight away, is that known as a non-desired outcome? If IFC candles sometimes don't get mitigated straight away, is that known as a non-desirable outcome? No. An IFC can be left unmitigated for weeks or months or years. And we have examples of that too. And it's something you're going to find yourself. A monthly IFC can be left unmitigated for years. And that's something that happens. So that's not something undesirable. That's something that's quite common. Sometimes it reacts on the start of the candle, and sometimes it reacts at the 50%. Exactly. It's, if you're basing on the definition of you enter on the open or enter upon the 50%, that is something random. You're actually guessing. You're guessing that you're hoping one day it's going to be the open, and the next day you're hoping it's going to be the 50%, but you don't really know. That's ambiguity, and that's kind of what the retail traders do. We don't want ambiguity. So that's something I used to do too, because that's what I thought was sensible. 50% because that's the average price point of the IFC, the middle point, and obviously you therefore half your stop loss size because you're entering higher up. So yeah, that's something that is an entry level analysis, but we're going to show you further on how to actually improve upon that. Cool. Okay, moving on to this stuff. Okay, I'm going to, let's just start here. So this is, from the top of my head, I think it's USD CAD. It's an example I want to cover later on in detail. But what we can see here is equal highs, FU candle. What did that FU candle do? It took out the stop losses that were here. The stop losses got taken out. And what else did it do? We had a break. That resistance now became support. So break, retest, buyers enter here. Stop losses are over here. And they are looking for that. Break, retest, continuation. The FU candle had other plans. The FU candle came up, took out the stop loss of sellers, then took out the stop losses of buyers. So we have a normal FU candle. What do we know about FU candles? They need to be mitigated. The reason they need to be mitigated is because they are more likely to be institutionally funded. And that's what happens here. And inside here, what you're going to see is so if that's our structure point, we had a break of structure over here, and then price came back up and it mitigated this IFC formed by this wick. And then it confirmed the movement down, etc. So that's kind of the stuff we're going to cover on the lower time frame. But essentially, this was our initial IFC/FU. That's the initial one. And then over here, the mitigation one, this is our banker block. And therefore, this is the entry based on the mitigation of that banker block. But again, that's something we'll cover later on. But here's just an example to show you what an FU candle and mitigation is going to look like. Okay, I'll leave this stuff for now because it's a different teaching block, but the FU candle will take from that for now. The next one over here, we have a very similar example, pretty clean. Here, this is something worth mentioning. This, if you were looking at price over here, and this therefore didn't exist, so we've only seen this, we could consider this a FU candle, right? And then therefore, if we were looking for a mitigation of that and entering there, we would take a loss because, you know, price blew through it. So what we need to do is we need to be a bit more sensible when we are analyzing and when we're taking a trade. Therefore, what we need is lower time frame confirmations. So over here, likelihood is we didn't have any meaningful break of structure. Therefore, it was not valid to enter. But over here, we had a clean break of structure. We took out these points of structure. So therefore, we know that this FU candle over here was meaningful because not only did it take out liquidity, it took out the stop losses over here. It led to some sort of meaningful reaction, which took out one level and two levels of structure. So now we can say that is actually a true FU candle. So it's not just about taking out liquidity, it's about the follow through as well when we want to define if it's worth trading. And then later on, it comes back mitigation. Okay, so we have the first FU candle. That FU candle is now mitigated. That process of mitigation forms something new inside here on the lower time frame, not in this time frame, which later on goes on to be mitigated. That is your entry of your banker block. This is actually a trade I took, and it's on my Telegram, and it was one of my first major risk to reward trades. It's USD CAD, I can remember. And essentially, it was the momentum trend line over here, which we'll cover later on. But yeah, that's one for later on today. But that's just showing you multiple concepts over here. And actually, let me just find a normal IFC for you all. Okay. This is your IFC zone. If we zoom right into it, we can see over here, IFC, mitigation. That is not a FU candle or anything. That is just a normal IFC. And the reason we like it is because it had some sort of meaningful follow through before it came back down. Right now, just for the sake of arguments, let's just leave the definition. Obviously, I'm going to improve upon it. Let's leave the definition as the last sell candle before you buy. Therefore, the last sell candle before you buy is this. Okay, that's not going to work. It's doing red. That candle right there is my IFC. The last sell before you buy candle before this bullish movement up. Therefore, because of that strong bullish movement up, and we can see how it is why it is a strong bullish movement, because we left imbalances over here. So because we left some sort of imbalances, that shows us that this movement up came with heavy momentum. There was strong buying pressure at the time. Who can cause strong buying pressure? Not retail traders. Only institutions can cause strong buying pressure. Therefore, if there is a strong buying pressure that leads to some sort of break of structure that happened over here, we know that the point that derived that movement is likely to be institutionally funded. What do we know about institutionally funded candles? Eventually, when price returns, they need to be mitigated. And that's what happened here. So you can see. Now, this right here, on this time frame, that is your banker block. On that time frame, and you can see it narrowly missed. We didn't actually mitigate it. It was narrowly missed. But if you came onto a higher time frame on the daily, for example, it would have hit. Now, how can we? That is one form of ambiguity. So I'm going to cover how we can actually understand a little bit better where we should be taking those entries. in this situation, because it's a trade I took, I remember over here on the lower time frame when Alex covers it, we had a lower time frame accumulation, so therefore I knew it wasn't going to come all the way down, and I actually entered upon, we had the spring over here, I entered upon the test. Again, we'll cover that later on, but there are multiple ways to address these problems that we will all face, because they're common questions. Another example here, 1 touch, 2 touch, 3 touch. We have equal lows. FU candle takes out the stop losses. Taken out. And you can actually see on a lower time frame that we had this IFC forming. We had a mitigation. And I remember this as well. This is GN. And later on, price came back in the future over here. And it tapped into something here. So again, we'll cover that when I cover GN. But it just goes to show how you can enter on the lower time frame on a banker block after an FU candle. Reason being is because we had equal highs. So we have our FU candle. The FU candle leads to break of this minor structure on the lower time frame. That is a break of structure over here, and leads to equal highs. Therefore, when price is coming back down here, we know that if it taps into here, we have reasons to believe we are now bullish because of that initial break of structure, and we have a target, which is these equal highs. So therefore, that bullish scenario is valid. And for people who are a bit familiar with Wyckoff theory, that FU candle is very analogous to a spring. So we had these equal lows, which is by the arrow, the previous equal lows. We had our selling climax, preliminary supply, selling climax. Oh, I did that wrong again, sorry. Selling climax, selling test, spring. Nope, let me mark it out. So we can see actually how smart money concepts and Wyckoff theory complement each other, where we can see the same factors of both schools of thought kind of saying the same thing, and therefore we can enter upon it a bit differently. When we cover Wyckoff theory, we'll show you how the theory differentiates from what we do when we apply it. But that's that example. Another very normal example here, equal lows. Over here. Maybe it can be extended over here too, based on that touch. Then we have a break of that. We have an FU candle formed over here. Price comes back up, mitigation of that, and then continues up. So very simple stuff there from smart money. We just have FU candle and then mitigation. Let's continue. Here's another example. Equal lows, FU candle. Now, people might be wondering, if this is my entire FU candle, do I enter over here? And then therefore, my whole zone of risk is over here. No, but this is the 4-hour time frame, and the answer is no, you don't just simply enter on guesswork. That's something that's like an entry-level thing that people would do, but we can actually refine, and there's a reason. I'll cover this on day 3, this example from a top-down perspective, because it's a good teaching point. And why we would enter down here as opposed to entering up here. Yeah, just to show, we have equal highs after the FU candle, then we have a mitigation, then we have continuation. Okay, this is our refined IFC. I'll teach that in a minute, but we can see we have an IFC mitigation, and it's valid because we had break of this structure. So we know that that break of structure, that means that we have a demand zone over here. Why is that a demand zone? Because buyers that entered the market over here, they had enough strength to take out structure. We had enough strength to take out this area of price. Therefore, we know that that is a price point where buyers come into the market, therefore a demand zone. And if that is a true demand zone, that is, in other words, an institutionally funded area. That's where institutions put in money to form that IFC. What do we know about IFCs? They need to be mitigated later on. So if you were to take this trade, from a normal smart money perspective, it's the last sell before you buy. So it's that black candle. So your entry will be over here. Your stop loss will be down here. Our version is a little bit different. I'll explain in a minute. It's over here, stop loss down here. So you can see, you can actually reduce your stop loss by 2/3 or 50%, whatever, just by a simple trick, which I'll teach you in a minute, with our refined IFC. But either way, it makes sense from both perspectives. We have a demand zone because it led to a break in structure. That demand zone that led to a break in structure had an IFC that provides our entry over here. Another example right here. Again, there's a reason it's not the last sell before you buy candle as opposed to this one, but you can see that we had that. We had a break of structure over here. Oh, not that one actually. Just this break of structure. So lower time frame break of structure came back down, mitigation, and then continuation up. So that right here. Okay, let's see if there's any more examples. Okay, this is an interesting one. Actually, what I'm going to do is, because I just keep saying I'll say it later, I'll just say it now. Let me teach you what the refined version is. Okay, so traditionally speaking, from smart money or wherever you've learned it, sponsor candle, order block, punch candle, sell before you buy, etc., etc. All of them are the same thing, but our version is a little bit different. So traditionally speaking, what you're going to be taught is, so in a buy scenario, we have price moving up, and then we have that movement down, etc. So we know that this is our IFC. That later needs to come back and be mitigated. We've covered that. That all makes sense. And your stop loss will be up here. Now, our variation is a little bit different, because if you were to zoom into that, what if you have a scenario where actually, normally speaking, this would be your IFC over here. Why? Because you had the IFC, and then you had a sell candle, and then you had another sell candle, and then the move presented. So that would over here be your IFC. This will be the one you trade. Now, that's fine, because in this situation you would get tapped in. But our refined version is this. Oops. So actually, I'm going to go into the chat. Does everybody know what I mean when I say the word engulfing? If I say an engulfed candle, does everybody understand what that means? Cool. Candle with, yeah, I like the word eaten. That's a good way to remember it. Bigger than the previous one, kind of. I'll cover it very briefly, but I think basically everyone knows what engulfing is. Actually, let me just... I'll come back to questions later. Okay, so engulfed is essentially in this situation, this candle, actually no. Candle number 1 was engulfed by candle number 2. Candle number 1 was engulfed by candle number 2. And how do we know that? Because the close closed below the previous candle. So we know that, like somebody mentioned, the candle number 2 has eaten candle number 1 because of its size in this situation. Candle number 1, has it been eaten by candle number 2? Because, okay, the close has, but the wicks have not. So right here, candle number 2 has not conclusively engulfed candle number 1, right? So this candle has not been engulfed by candle number 2 because we have not had a convincing close. It's kind of ambiguous. There's no confirmation. But has candle number 2 been engulfed by candle number 3? Yes, it has. Both the close price and the wick, both have been taken out. So that we can, in this situation, say candle number 2 was conclusively engulfed by candle number 3. What about, I'm just trying to think of more variation. I'll find more variations in the charts, but it's just to emphasize the point that when there's an engulfing, we need something convincing like this, like candle number 3, or in this case, candle number 2, where the candle before, the candle of interest, is completely taken out, both wick and body, by the preceding candle. So when I come to the example, over here, we can see that from traditional theory, your last order block, your last sponsor candle, your last punch candle, your last sell before you buy candle is this one. That was the last bearish candle, the last sell candle before price started to move up. So therefore, if you are looking to trade just based on smart money, you would enter here. And again, that could cause some doubt because that might be already mitigated. But either way, if you were to take that trade on a higher time frame, you'll be looking to enter over here. And your stop loss was defined also by that candle. Therefore, your stop loss is down here. And, there's nothing wrong with that. You got tapped in, it didn't hit your stop loss, you still got a reasonable risk reward. But the refined version is over here. So we are not looking at the last sell before you buy candle. That is what most people teach, or everyone teaches. We noticed that basically, 95 times out of 100. So almost a fact. Obviously not every time, but pretty much the majority of the time, this small little trick of looking for the engulfing, that truly defines what is a true IFC in our opinion. And that's something we've backtested. That's something we've traded. And again, this is something I can teach you in 5 seconds, but it really reduces your stop loss down, 20% to 50%, sometimes 2/3 and beyond. It has a profound effect on your risk to reward just by simply understanding what is a true IFC. So in this situation, or in every situation, basically, we are looking for the candle that got engulfed. So let me do the numbering thing again. If this is candle number 1, candle number 2, candle number 3. Was candle number 1 engulfed by candle number 2? It was not. Let me draw it out. Candle number 1 is over here. That's the range, right? Candle number 2 is still inside that range. There was no engulfing. Candle number 2 did not eat candle number 1. So therefore, I cannot confidently say candle number 1 is an IFC. I cancel that one because there was no engulfing. So if we are talking from a logical perspective, what is the reasoning behind that. We'll dig a little bit deeper. If candle number 1 was truly an IFC, then why was the following candle not an institutional push? The whole idea behind IFC is that's where institutions have put in money, and therefore we are looking for an injection of volume, we're looking for some sort of volatility. So after the IFC is formed, we want some sort of imbalances, we want heavy bullish momentum, we want some strong reaction to indicate to us that that was an IFC. Right over here, candle number 1, the following candle was actually smaller, and even though it was a bullish candle, that does not mean it was a successful IFC. For me, that is not a true IFC. So the reason we have our candles black and gray, as opposed to the traditional red and green. Red and green is going to show you what is a bearish candle, what is a bullish candle. And when we realize that this IFC stuff, it's not relevant what color the candle is. It's not relevant if it's a bearish candle or a bullish candle. If you're trading normal smart money, you'd be looking at this candle right here because that was your last bearish candle. So that would be a red candle. So you'd be looking out for the red candles before the green candles came into play. So you'd see this is my green candle, this is my green candle. And then you say, okay, therefore my IFC is that last bearish candle. But as we can see from here, and plenty of examples which we'll show you over the next sessions, the true IFC is this one. The reason is a true IFC is because candle number 2 was conclusively engulfed by candle number 3. So therefore we can say that this IFC that is formed over here, that led to a true reaction because we had a true engulfing. So we can say that on a lower time frame we had strong bullish price action. And even on this time frame we can actually see candle number 2, that's the range, and then candle number 3 moves heavily bullish, and then candle number 4 leaves that imbalance there. So we can say because of that imbalance and because of that engulfing, that is a way more reliable, true, refined IFC. So that's how we actually take our trades now. We're not looking at the last the last bearish candle to define our IFC. We're actually looking for that engulfing. I'll improve upon it later on as well, and how we take it one stage further. But for the time being, just realize that you should probably also change your candle colors to black and gray or whatever neutral color you want, just so you don't get confused or influenced by the color of the candle, because we are not looking at the color of the candle. It's irrelevant if it's a bearish or bullish candle. Rather, we are looking for the nature of that candle. And the nature of the candle we are looking for is a true engulfing, preferably with some sort of reaction that has an imbalance, because that demonstrates to us there was strong bullish momentum. Does that all make sense? What if you have 2 dojis and the second doji engulfs the wick, but not the body of the previous one? If there's 2 dojis, go for the second one, but not the body of the I don't understand. What if 2 dojis and the second doji engulfs with the wick, but not the body? If it's ambiguous, so it engulfed the body but didn't engulf the wick, that's where there's a bit of a gray area. And what we would usually do is change time frame. So the time frame would give something conclusive. That's the answer to that. But yeah, that is a gray area, because sometimes what you're going to see if you're sticking to that time frame, sometimes if it's an engulfing of the body, it does mitigate, but other times it won't mitigate because it didn't cover the wick. So that is a small gray area, and the best advice we can give to overcome that is change the time frame until you find something conclusive. I thought all the body has to be eaten. Yeah, the whole body and preferably the wick as well. Yes, on any time frame, Lawrence. I don't know what the true definition is from a retail perspective. Just our version of engulfing is basically we want to see some sort of conclusive movement, and therefore, the follow-through candle. So once we have our refined IFC, the following candle needs to be conclusive. So in this situation, I label them again. Candle number 1, 2, and 3. Candle number 3 conclusively engulfed candle number 2, but candle number 1 was not conclusively engulfed. So you're just looking for that conclusive engulfment. It doesn't matter if it's the wick or the body or whatever. If there's too much doubt, change the time frame until you find something conclusive. But we're not looking at a set of rules. We're looking at more of the logic. try and follow the logic that candle number 1 is not likely to be a true IFC. Why? Because the follow-through candle was not it was bullish, but it was not strong bullish momentum. So that tells us that it doesn't matter. Like, the institution didn't pump in their money just yet. But on candle number 2, the follow-through candle was very bullish. We had an imbalance, we had an engulfing. Therefore, we can say that there was a follow-through, there was an injection of bullish orders. Therefore, that is more likely to be our true IFC. What we have to realize is this. These trading view times, they are packaged for us, right? On every hour close, you're going to get a 1 hour close candle. Every 4 hours, you're going to get a candle close. And that's defined by, the clock. At every 60 minutes is 1 hour, and that's how trading view times work. And that's how everything's going to work. But price is not bound by time like that. Price is not, I don't believe price and time are correlated in the sense that we are taught. For example, you might have (1 hour, 2 hour, 3 hour, 4 hour). We have 4 1 hour candles, and that is packaged into one singular 4 hour candle. But what if my IFC of interest was formed over here? It was formed in the space of 1 hour also, but it happened between 11:30 and 12:30. If I'm to look at it based on the 1 hour time frame, I'm going to see half of it here, and I'm going to see half of it here. I hope everyone's following what I'm trying to demonstrate here. I'm trying to demonstrate that the trading view time frames are packaged in certain ways that does not truly represent what price might be showing us, because things can happen in between hour closes. It can happen in between time frames. That's why we need to be really flexible with every time frame we use. When it comes to the lower time frame, people ask us, which time frames do you use? Do you use the 1 minute, 5 minute, and 15 minutes, etc.? The answer is no. When it comes to the lower time frame, we're going to use the 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, all of them, because each single time frame is telling us something a little bit different. So when I'm looking to take a trade based on the 1 hour, I'm also going to look at the 2 hour. I'm also going to look at the 45 minute. I'm also going to look at the 30 minute. We need to be flexible between all time frames to find the things we're looking for. For example, the engulfing. So the 1 hour time frame might not show a conclusive engulfing, but if you jump down to the 45 minute time frame, you might see a conclusive engulfing. So therefore, you take your trade based on that, because the data on the charts is not happening. The institutions or whatever, they are not conveniently packaging these things for us based on trading view times. An IFC might be formed in 8 minutes, and if you're looking at the 5 minute time frame, you have not got the full picture. Or if you're looking at the 10 minute time frame, you've still not got you've got too much. You have got too much data to what you need. But if you're remaining flexible and fluid between all of the time frames, you're more likely to see what you need to see. Refined IFC plus imbalance left behind. That imbalance left behind is something preferable, but it's not a requirement for what I'm teaching right now. I know actually you've already done the course, so you already remember and know. But for the time being, the refined IFC, it does not need to be defined by an imbalance, but later on we're going to tie in the imbalance as well. But just for now, just remember it as some sort of engulfing. Isn't engulfing when a whole body's taken over? Again, it doesn't matter about the retail definition, just try and follow the logic. The source. Okay, if you don't get it still, when we cover more examples, you'll figure it out. And if not, we have the follow-up sessions. So you can scale down timeframes to find the refined IFC. Correct, Leon. We want to jump between timeframes to find the thing we're looking for. Are you looking at the imbalance left there? That imbalance left there added to my argument, but it's not a necessity. We'll tie in imbalances later on. In the example you gave, the open of the lowest down close candle still gave a good support for a decent run up. We'll cover that one again, Grant, because I don't remember what you're referring to. So okay, stop loss placement. Good question. If I'm taking my trade based on if I was taking my trade based on the normal IFC, the last bearish candle, so candle number 1, my entry would be here, or the 50%. And your stop loss would be down here at the low. So if you're not taking the 50% entry, and this goes to show, by the way, why the 50% entry works at times. Whoops. The reason the 50% entry works at times is because of the imbalance stuff I'm going to teach you later on, or because it comes to a true IFC. But coincidentally, it looks like it hit the 50%, but 50% has no actual bearing. What does the 50% actually mean to an institution? It doesn't mean anything. There's nothing correlated with price right there. You know, it's convenient, it works at times, but there's no fact behind it. There's no logic behind it. We are looking for that precision or logic of why that 50% works at times, and other times it's just open price, and other times it is the 50%. It's probably something to do with this stuff we're teaching now. But yeah, for stop loss placement, if we are taking the trade based on candle number 1, our stop loss will be down here. If we're taking the trade on the refined version, you'll have your stop loss here. So you'd have a change stop loss and you have a change entry. Now, I don't want to give you a blanket statement right now and say that's the rule of thumb, because it's not. What you need to actually do is, because the difference between here and here might be 2 or 3 pips. It might be something irrelevant. So you don't want to be, taking a loss on a trade for the sake of 1 or 2 pips because you were choosing these stop losses. So how can we confirm which place to put your stop loss? If it's on a daily time frame and the difference is 5 pips, go for this one. Go for the stop loss over here. But if it's on the 5-minute time frame and the difference between the two is 0.5 pips, I will just be on the side of caution. I'm just going to increase my stop loss by 0.5 pips or 1 pip or whatever, because it's not worth the risk. You don't want to be greedy in that sense. But if you want some more clarity, what we're going to do is this. Let's zoom into it. How is it coming out? I'm going to exaggerate it a little bit just to emphasize the point. So this is candle number 1. This is candle number 2. Say, for example, we're seeing price like this. Etc. If we see some sort of imbalance inside candle number 2, that is a positive. But for the stop loss placement, there was 2 options, right? We could either place our stop loss based on this, so over here, or do we place our stop loss down here? How do we know? And if it's the sake of 5-10 pips, then I'd want the lower one. But if it's the sake of 1 pip or 0.5 pips, be cautious. There's no point being greedy. Just be on the side of caution in that sense. But how can we confirm it? We confirm it by the lower time frame. We're going to see IFC mitigation. IFC. I didn't draw that correctly, but IFC over here, mitigation, newly formed IFC over here, and let's assume that was mitigated as well. So what are we seeing? We are seeing IFC mitigation, IFC mitigation, IFC mitigation. So we're having bullish order flow. That is one positive thing. But what are we also seeing? That this price does not need to, if prices come here in the future, we do not need to have this stop loss. Why? Because this has already been mitigated. So price doesn't need to come back here. Does price need to come back here? It doesn't, because it's already been mitigated. Does price need to come back here? It doesn't, because it's already been mitigated over here. And now this candle over here. Does price need to come back here? Yes, because after that we had a strong bullish movement. We left the imbalance. So therefore this candle right here does need to be mitigated. So therefore we need to have a stop loss that accounts for this candle, but doesn't need to account for these candles because they're already mitigated. So that is kind of when, you need to look with things like with a microscope and actually understand where are you logically placing your stop loss. That's why I didn't want to give you a blanket statement and say, just place your stop loss over here or place your stop loss over here. I'd say a general rule of thumb, you're safe if you're doing it based on the true IFC, but you need to confirm it with the lower time frame and see, is there a reason why you wouldn't extend it? If there's bullish order flow and everything is left mitigated, then price does not need to return. So you do not need that, larger stop loss. But if there was this candle right here that was not mitigated, then you would need to extend your stop loss because there is a possibility price comes lower. So you just need to, read the lower time frames and see, is everything accounted for or is there things unaccounted for? If there is things unaccounted for, increase your stop loss because that means there is a possibility price is going to return. Would you say the 15-minute before the close of the hour is a good idea to trade? Probably not. I don't think that has any bearing or any reason. Nothing major happens there, so I wouldn't recommend that. Yeah, 45-minute time frame is a very good time frame to use as well. We'll cover this on, if you're looking at so many time frames, how will you know? When we go through examples, we'll explain why we disregard some and why we take others into consideration. Yeah, if you have an IFC and no break of structure, it is still valid, correct? I'll find more examples with engulfing, no problem. Stop loss stuff I covered. Wow, awesome. Yeah, mitigation is a retest essentially, but you need to understand why there is a retest. Like, why does price need to come back? From a retail perspective, it doesn't give you a reason. Why does price need to retest? Retest for what? But now we've given you some sort of understanding that, okay, the reason there is some sort of retest is because you need to have some sort of mitigation of institutionally funded orders. Yeah, we'll go over loads of real examples, don't worry. Cool. Okay, let me see if there's more examples because there was a few. Okay, this example here is GN. I will cover this in detail and why we didn't enter over here and why we entered down here. You can see over here, because this is a 4-hour time frame trade. If you were to enter, especially because it's GN moves a lot of pips. Over here is likely to be 40 to 50 pips. Over here where we entered, I think that was 15 pips off the top of my head. So you can see your risk to reward was increased by a factor of 4 just by understanding what a true IFC was. The answer to this one on the 15-minute time frame, that was the true IFC with the engulfing. But let me find some better examples. Okay, similar example right here. If you are looking at the last bearish candle, the last sell before you buy, your entry therefore should be up here and your stop loss should be down here. So therefore that becomes your whole area of risk. Therefore you're going to experience this much drawdown. When in reality, if you understood what was going on, we saw that, candle number 1, candle number 2, candle number 3, candle number 4. Okay. Was candle number 1 engulfed by candle number 2? Nowhere near. It was not. Was candle number 2 engulfed by candle number 3? Ambiguous. The body did, but the wick, for me, that's not a conclusive follow through. You could argue that candle number 3 was engulfed by candle number 2, and it would play out. But for the sake of clarity, I would much rather just go with candle 3 because the follow through on candle 3 to candle 4 was conclusive. This is the range of candle number 3, and candle number 4, wick and body, conclusively closed above. And more importantly, we have, it's hard to show. We have an imbalance. I hope everyone can see that. So candle number 3 was engulfed by candle number 4 and left an imbalance. So that's why I preferred it over candle number 2. And candle number 1 is out of the question. That one doesn't make sense. And later on, price comes back and, it comes back to candle number 3. But also, if you chose candle number 2, you're also fine. But in this situation, logically, candle number 3 makes more sense. Your stop loss would be here because of candle number 3's range. And your entry was obviously over here. Your risk is now from this area over here, as opposed to this entire area over here. Significant difference to your risk to reward. And that's what we're looking for. We're looking for that level of precision. Let me see if there's any more examples.
Waka, I think it was one at the beginning. The one that had the big handle at the top. The other one.
I'm just trying to see if I can freestyle some examples because they are all over the place.
Yeah.
But yeah, I remember there's one at the top. Cool. Oh no, we're at the top. Here, yeah.
Yeah, the difference.
We can see that we're looking at the candle that was engulfed. So if this is candle number 1, candle number 2 conclusively engulfed, and therefore that was your mitigation. But if we're looking at the definition of last bullish candle before a sell, this would be the candle of interest. So would you have been entered into the trade? Yes. Over here, you would have been triggered, but your stop loss would need to be all the way over here. Therefore, your zone of risk is all of this, whereas our zone of risk and stop loss, so we would enter in the same place, but our stop loss would be over here. Therefore, our zone of risk is here. So quite a significant difference by a factor of 3 or 4 again on the size of your stop loss. Therefore, your risk to reward is increased by a factor of 3 or 4 just by knowing this. So a very, very significant thing. This example here is the same from traditional to what we would do, because this candle number 1, is engulfed by candle number 2, and it happens to be the last bullish candle before a bearish movement. So that's equal either way. But this would actually be a banker block. We have our refined IFC, mitigation, and banker block, mitigation. So therefore, stop loss over here, entry over here, and that's how you scale in. So IFC, banker block, and both would provide great risk reward, both would trigger in, and then your, this is your risk. All of this is your reward. Just by correctly understanding these candles, it has a great impact on your risk reward. But yeah, when we go into live charts, because of the examples we're going to show, obviously we're taking trades, actively doing this. So when we cover our live examples, you're going to see plenty of examples of us doing that. Okay, let's leave it there for now. Covered. Alex, was there anything else I needed to cover in this block? I forgot.
I think you're good.
Yeah, okay. All right, guys, does that all make sense up until now?
Yeah.
Stop loss on the wick of the candle or below the wick, like in the... Okay, what you need to do is, technically speaking, you need the stop loss exactly where the wick of the candle is. But you also need to factor in your spread. So what we would just recommend do is just slightly below the wick to account for spread. But if it's a true IFC, it shouldn't come all the way back down to the bottom of the candle, because what will that do? That's going to leave equal lows.